Come to this next paragraph number 9, joint venture. We have seen the features of joint operation. 1. If there is no new separate legal entity formed, it is a joint operation. Even if a separate new entity is created, check whether the operators have right to asset, liability, revenue, expense, output separately. If yes, then it is a joint operation. The other type of joint venture arrangement is called joint venture. In this standard, we have to only identify that it is a joint venture. And once it is proved that it is a joint venture, then we will have to go to IAS 28 for applying equity method of accounting. Okay. So what is a joint arrangement? Where the parties that have joint control of the arrangement have the rights to the net asset of the arrangement. That means they are not entitled to individual asset and liability. They are entitled to net asset, means asset minus liability, whatever amount will be left out, they will get a share in that. But they cannot claim separate individual asset or liabilities. A joint arrangement in which the assets and liabilities relating to arrangement are held in a separate vehicle can either be a joint venture or a joint operation. So we need to make it very clear, a separate vehicle can be a joint venture or a joint operation. Some students make it as a point to remember, no separate vehicle, joint operation, separate vehicle, joint control, joint venture. That is a wrong summary. A separate vehicle can be either of the two. We have to see whether the parties to the joint arrangement, those who have joint control, do they have stake in the net asset or will they claim separate asset and liabilities? Now, who is a venturer? Venturer is a party to the joint venture, but at the same time he must have joint control over that venture. That means he must have control along with some other venturer, and together they must take the decision unanimously. Some people in the joint venture are not venturer. They are just investors. That is, they have invested their money, but they do not have power to take decisions about relevant activities. So such people are not venturers. They are investors. Okay. About investor we'll discuss separately. Now once again we have made a flowchart to identify whether it is a joint operation or joint venture, because that is the theme of this chapter, nothing else. First is legal form of separate vehicle. Legal form of separate vehicle. Does the legal form of separate vehicle give the parties right to assets and obligations for the liabilities relating to the arrangement? So there is a legal entity, separate legal entity, but the parties have right to assets and liabilities relating to arrangement separately. If the answer is yes, then it is a joint operation. If the answer is no, then I will see the terms of the contractual arrangement. Do the terms of the contractual arrangement specify that the parties have the rights to assets and obligation of the liabilities relating to the arrangement? If again the answer is yes, one is the structure is such that they will get separate share in asset liability. Second, contractual terms give them separate asset liability relating to arrangement, joint operation. If the answer is still no, then apply other facts and circumstances. Have the parties designed the arrangement so that its activities primarily aim to provide the parties with an output, that is, the parties have right to substantially all the economic benefit of the asset held in a separate vehicle. Like in case of oil pipelines, it happens that they will be entitled to all the outputs. They normally do not sell the output. Then that is also a case of joint operation only. But sometimes they allow the output to be sold to outside people also. And if that is the case, then it will become a case of joint venture. So now this is a very clear flow chart. And if you have any doubt, you have to refer this flow chart. This will tell you whether it is a joint operation or a joint venture. Either the nature of the legal entity gives you separate asset and liability, contractual terms gives you separate asset and liability, or contractual terms allows the party to get the output directly, then it is a joint operation, otherwise joint venture. Now some questions we will discuss. ASF Limited has a joint arrangement with two other companies to share the control of XYZ Limited. The arrangement states that all the three companies have an equal say in running of XYZ Limited. Will this arrangement be treated as joint venture? The question is so brief that we really can't say, but then if you have to take a stand, the answer would be yes, because a new entity is created. So if a new entity is created, if question does not have sufficient detail, one can assume that it is a joint venture. So answer is that, write down, I think I have written, the arrangement will be treated as joint venture. And once it is treated as joint venture, then you will apply equity method of accounting as per IS 28. Come to one more question for discussion purpose. Question number 11. Is it 11 number? ECL Limited has a wholly owned subsidiary, entity B, that holds a portfolio of building. ECL Limited wishes to reduce its exposure to this market. It sells 50% of the investment in entity B to an investment bank. So ECL and there is one investment bank. ECL and investment bank enter into a contractual agreement whereby decisions regarding entity B's relevant activities are made jointly. So there is a joint agreement, there is a joint control. ECL Limited continues to act as an asset manager of entity B for a specified fee, and decisions are made in line with the entity B's pre-approved budgets and business plan. Is entity B jointly controlled? So there is a joint control because decisions are made jointly. There is a contractual arrangement and the decisions have to be taken as per the pre-approved budgets and business plan. So all these factors indicate that this is a jointly controlled enterprise. Okay, joint venture. Entity B is jointly controlled, as ECL Limited and investment banks are required to agree unanimously on relevant activities, and ECL Limited must manage the entity's operation in line with these decisions. So most of these questions that we have done are basically asking you the same problem. Is it a jointly controlled, is it a joint arrangement? Is this standard applicable? Now we will discuss one more paragraph, party to a joint arrangement, paragraph 10. So an entity that participate in a joint arrangement, regardless of whether that entity has joint control of the arrangement. So all parties in a joint arrangement are party to a joint arrangement. They may have joint control, they may not have joint control. What is a separate vehicle? It means basically a separate entity, but they have defined in a more complicated way, a separately identifiable financial structure, which means it can be any form of business like partnership, LLP, private limited, public limited, listed entity, including separate legal entity or entities recognized by the statute, regardless of whether those entities have a legal personality. So it means a separate entity where we can identify asset, liability, income, expense, cash flow, output separately. And now we will come to accounting part. So what we did today, we first understood the meaning of joint control, joint arrangement. When will it be a joint operation? When it will be a joint venture. Parties to joint arrangement, separate vehicle, venturer, joint operator. But then ultimately, what is our objective? Accounting. So this chapter will deal with accounting for joint operation. Accounting for joint venture will be further covered by IS 28. So the standard is very simple. It says if it is a joint operation, then joint operator, who is a joint operator? Party to joint operation, and he has joint control, recognizes in relation to its interest in a joint operation. So what each operator will do, they will just record his share in assets. They will record their own asset because no new entity is usually created. So whatever asset they own will be there. Plus they will also add its share of any asset held jointly. Plus its share of any asset held jointly. Like for example, a building given on rent and it is jointly owned by two or more entities. Then you will record your share in that asset. Then its own liabilities which you have incurred, of course, and plus its share of any liability incurred jointly. Any share in the common liability, and then its revenue from the sale of its share of the output of the joint operation. So your share in revenue from joint operation. Point 4, its expense, means whatever expense for which you are directly responsible, and plus its share of any expense incurred jointly. So they could have just written in one line, your own asset, liability, income, expense plus your share in asset, liability, income and expense of the joint operation. So what will be the further treatment of such items? Suppose I have a share in property, plant, equipment of joint operation. This will be further accounted as per IS 16. Okay. Or I have a stake in the revenue. To that revenue I will apply as per IFRS 15. Okay. A joint operator accounts for these assets. Our asset or our share in the joint operation asset. The individual item will be then further accounted as per applicable standard. What about those parties that participates it in but does not have joint control of a joint operation? Participates it but does not have joint control of a joint operation. We shall also do the same accounting. Shall also account for its interest in the arrangement in accordance with the above, if that party has the rights to asset and obligation for liabilities relating to joint operation. So even these other parties will also apply the similar accounting. Now we'll solve a very simple question just to see the application of joint operation accounting. Question number 5. ASF Limited and Reliance Limited agree to manufacture goods in India and sell in UK. All manufacturing and selling activities require unanimous consent during 2019-20. And then there are some transactions given: sale of goods to UK, expense, machines were required for manufacture of goods, loan taken for such machinery, Ratio of sharing between ASF and Reliance 60:40. Whether the business of manufacturing and selling is joint arrangement. And prepare extracts of separate financial statement of ASF Limited. So is the first answer yes? Yes, but we'll write it properly. So write down the answer in notebook. Write on a fresh page name of the standard IFRS 11 joint arrangement. Question number 5. First answer whether this is joint arrangement. So I will check the conditions and then I will write the response. If the answer to all these questions are positive, then we will conclude that yes, it is a joint arrangement. So first point 1, whether there is a contractual arrangement. Yes, ASF Limited and Reliance agree to manufacture goods in India and sell in UK. So that is nothing but a contractual arrangement. So point number A, right, contractual arrangement, question mark, yes. Then second question, whether parties are capable of controlling the relevant activities. Parties are capable of controlling relevant activities. So whether there is a joint control over relevant activities, yes. And third, whether unanimous consent is required. Again the answer is yes, that is printed in the question only. All manufacturing and selling activities require unanimous consent. Yes. So then you first write down one conclusion. Conclusion, there is a joint arrangement. Conclusion, there is a joint arrangement. Then write down whether this is a joint operation or joint venture. That question they have not asked, but I am writing myself. Whether it is joint operation or joint venture. Do we have a new entity created in this problem? No. So answer write down, it is a joint operation as it is an unstructured entity. It is a joint operation as it is an unstructured entity. Now tell me, how will you prepare the SFS of ASF Limited? So in the statement of profit and loss, this is statement of profit and loss. Sales I will record. Of course, I will record my own sale, which amount is not given, plus our share in the sale of the joint operation. So assuming they have agreed to share in the ratio of 60:40, ratio of sharing for all items is 60:40. So 6 lakh, 60% of 10 lakh. And point B, right, expenses, own expenses, plus 60% of 9 lakh. 60% of 9 lakh is 5.40. 5.40. Then write down point 2, SOFP extract, statement of financial position. In property, plant, equipment, there is a machine which they have acquired for manufacturing of goods. So our share in asset, 60% of 6, 3.6 lakh. Whatever assets we own ourselves will come, and plus our share in the asset, 3.60 lakh. And point B, non-current liability, where there is a loan printed in the question, loan taken for machinery. So we will record whatever borrowing we had, and then 60% of 1 lakh, that is 0.60 lakh. Is it right? Written. Next paragraph. Write one homework today. Check this question first. It is an important question. Do it as homework. Question number 12. Write down homework. Question 12. Okay, now come to this question. This we will solve. It is printed in your book also. Question number 16. P and Q form a joint arrangement, PQ. Using a separate vehicle, P and Q each own 50% capital in PQ. However, the contractual terms of the joint arrangement state that P has the rights to all of the machinery. Now, even this arrangement will be called joint operation because separately they are allowed to take machine will be taken over by P, or he has a right over P. An obligation to pay bank loan in Q. P and Q have rights to all other assets in PQ, an obligation for all other liabilities in PQ in proportion of their capital share. Balance sheet is given below. What would you record in P's financial statement to account for its rights and obligation in PQ? So there is a small drafting issue here. P has the right to all of the machinery and the obligation to pay bank loan in PQ. Bank loan in PQ, not in Q. Only Q is wrong, PQ. Now, first of all, we have to see whether there is a joint arrangement. The answer is yes, question has cleared that on the screen. And then whether it is a joint operation or joint venture operation, because parties are entitled to assets and liabilities separately. Okay. And if the answer is joint operation, then each party will record his share of assets and liabilities. Question has only asked about how will P record in its financial statement. So P will show the following item in its separate financial statement. First, machinery 2,50,000. Then cash, we have only half share in other assets. Okay, 50%, 25,000. Capital half, 75,000. Bank loan, bank loan 75,000 full. I'll come to that. Other loan half, 37,500. Capital you remove. Next paragraph in your notes now. Come to paragraph number 13. Accounting for joint venture. Only one line. Refer IS 28 using equity method. So this standard will not be applicable. You have to fully apply IS 28. And what about separate financial statement? In separate financial statement, if it is a joint operation, then joint operation will be accounted as per this standard. But if it is a joint venture, the joint venture will be accounted in accordance with IS 27 in separate financial statement. In SFS, joint operation will be accounted as per this standard, but joint venture will be accounted as per IS 27. Now solve one more question for a joint venture problem. ASF Limited and Reliance Limited formed ASF Reliance Limited, new entity. So chances are high that it is a joint venture. ASF holds 60% share and Reliance holds 40%. All relevant activities are directed in accordance with the contract. It requires unanimous consent. Financial statement of ASF Reliance Limited, that is a separate entity. P&L account, sales, expense, profit. SOFP, non-current asset, PPE, share capital, other equity. Share capital is contributed by A and B. prepare extract of SFS and CFS of ASF. So how many answers I have to write? 2. Under each of them again 2. SOPL, SOFP. Is it right? Only whatever is relevant you write from this much information. You have to prepare extract. You don't have separate data of ASF. Only whatever is relevant from this much data you will write. Now this question, first I will have to check whether there is a joint arrangement. So just orally discuss, same like previous problem. Whether there is a contract, yes. Whether parties are capable of controlling relevant activities, yes. Whether unanimous consent is required, yes. So this you will copy from that previous answer 5. But the next answer will change, whether it is a joint operation or joint venture. Then your answer will be it is a joint venture as it is a structured entity. Now we'll come to the answer part. We have to answer how will ASF Limited will present in separate financial statement and consolidated financial statement. So in separate financial statement, IS 27 will apply. IS 27 will apply. Do we need to add our share in revenue and expense? No. This will not be added. That is for joint operation. That is not for joint venture. So write down separate statement of P&L account. Sales, only our sales will appear. We do not add the sale of joint venture in the separate financial statement if it is a joint venture. Expenses, own expenses. And in separate SOFP, extract, only what I'll do, I will show investment in joint venture. And we will assume cost model. We'll assume cost model. So our cost is 60% of share capital 4, that is 2.40. Write cost model. And then point number 3, consolidated P&L account. In consolidated profit and loss, we will record our share in the profit of joint venture under equity method. Under equity method, there are 2 effects given. Carrying amount of investment is increased for our share in the profit, and the corresponding contra effect is given in consolidated P&L account. So these are the 2 effects in equity accounting. And then write down consolidated SOFP, extract, non-current asset. Investment in joint venture, write cost, add share in profit of joint venture, 0.6. So the answer is 3. Okay. And now we have completed this chapter. Come to summary. A quick summary of what we discussed today. First column write particular. Second column write joint operation. Third column write joint venture. Now write down structure. Structure write. Generally not structured through a separate vehicle. Generally, okay, because there can be a separate vehicle also. So generally not structured through a separate vehicle. joint venture, right, structured through a separate vehicle. Structured through a separate vehicle. Point number 2, write down terms. Joint operators have rights to individual assets and obligations. Joint operators have right to individual assets and obligations. For individual liabilities of joint arrangement. For individual liabilities of joint arrangement. And here write down venturers have right to net asset of the joint arrangement. Venturers have the right to net assets of the joint arrangement. The parties have no interest. The parties have no interest in bracket, that is no rights, title or ownership in the assets of the arrangement. The parties have no rights, title or ownership in the assets of the arrangement. So they cannot claim the asset. They can only claim the net asset. Point 3, write down revenue, expenses, etc. The arrangement establishes an allocation of revenue and expense. The arrangement establishes an allocation of revenue and expense. This could differ from ownership interest. This could differ from ownership interest. However, profit may also be shared. But there is no restriction that profit will not be shared. Profit may also be shared. But normally they allow you to share revenue and expenses. And now write down joint venture. The arrangement establishes each party's share in the profit or loss of the arrangement. The arrangement establishes each party's share in the profit or loss of the arrangement. Point number 4, applicable Ind AS for accounting. Applicable IFRS for accounting, right? Applicable IFRS for accounting. So here we'll follow IFRS 11. For joint venture in SFS, IS 27, and for CFS, IS 28. But even in SFS, you can follow equity method of accounting. Now this chapter is over. There is a small ignorable difference between the two standards. And what is the difference? In Ind AS 103, there is a reference of business combination under common control. Okay. But IFRS 3 does not have any business combination under common control concept. So on that point, there is a difference. I'll just quickly read for you. That paragraph B33D refers to accounting specified in Appendix C, business combination under common control of Ind AS 103 for the acquisition of an interest in joint operation. when the parties sharing joint control, including the entity acquiring the interest in the joint operation, are under the common control of the same ultimate controlling party or parties both and after the acquisition, and that control is not transitory. So that is mentioned in Ind AS 103 that these parties are under common control. Do we have a similar concept in IFRS 11? No. IFRS 11 scopes out same as the same scopes out the same as IFRS 3. Business combination does not deal with business combination under common control. So that business combination under common control is not a part of IFRS syllabus only. Okay. Other than that, whatever accounting we have discussed remains common for both the standard Ind AS 11 also, Ind AS 111 and IFRS 11. So there is a wrong number printed in the heading Ind AS 111. Now we will continue